Hello, good morning, and welcome everybody to today's Monday morning market briefing from our very own Financially Speaking series. I hope you all had a lovely weekend and are ready here with us to break down some of the key headlines of the week. Just so you know, this is recorded and we are finding new ways every week to distribute the recording. So if you do miss anything, you can always come back to it as well. And if you do have any questions whilst we're going through, there will be a Slido link that is dropped into the chat box very shortly, and you'll be able to ask anything that you might have in there. If, of course, you do see anything in the week as well whilst you're going through the headlines, just drop us a message at hello@myfinancialfreedomcoach.co.uk, and we'll do our very best to weave it in as well. And again, answer any relevant questions that you might have in advance. Morning, Lisa. How are you?
Morning, doing well, thank you. How are you this fine Monday morning, Zoe?
Very good, thanks. It's looking crisp and lovely. Oh, excuse me, but a little
Bless
sneeze
you.
to keep us. So, as I mentioned, there will be a Slido link to ask any questions that you might have in the chat just shortly. And without further ado, I will kick off with what we're all here for today. So I'll be breaking down whether this is your first Monday morning market briefing or whether you're a seasoned guest. I'll be breaking down, as usual, one thing that we've done to get us closer to financial freedom this week before going into the UK, the US, Europe, and the rest of the world as well. In the mix, we'll also have a read of the week to keep some of that reading material up for you. So first up, one thing that we have done to get a little bit closer to financial freedom this week. Lisa, I'll let you kick off.
Fantastic, that sounds great. Yes, so I've done a couple of things this week actually, so I'll talk you through both of them very briefly. So the first one is, as we're kind of getting towards the end of the year, I usually review my portfolio kind of end of November, start of December to rebalance anything if that needs doing. So I've been doing that recently with my pension. And I've also been looking into how much of my ISA allowance I have left. Again, with a view, we're just over halfway through the year, really. So we're really heading towards the 5th of April, which in the UK is the end of the tax year. So I've been looking at that and kind of like dividing by the number of months that are left to see how much I would need to add effectively each month. Yeah.
Lovely. Both big tasks to tick off in 1 week. Mine is a little bit smaller, but I have simply been checking in on the budget as it's around the middle of the month. And when I say budget, I don't mean the big one. I mean my own personal little one. It's about the middle of the month. So for me, I always have a little look in as to how things are going, how much has been spent and how much is left. It's not necessarily something that I personally track religiously or within a massive spreadsheet, but it's something that I keep on top of a little bit more frequently. So that's one thing that I've done this week to get us closer to financial freedom, and Lisa as well. Unfortunately, we won't be joined by Victoria this week, but hopefully she will be back next. So let's take a look at the major markets. The FTSE 100, which is a measure of the 100 biggest companies in the UK, ended the week ever so slightly up by a whisker, up by 0.16%. The S&P 500, which is a measure of the 500 biggest companies in the US, finished the week in the red, down by 0.76%. The NASDAQ, which is the tech index, had a slightly more woeful end to the week, down by 1.95%. The Eurostoxx 50 is about the only good news for the week, and it finished up by 1.52%. Now, if you start to see these index readings relatively regularly, you start to get a feel for how much they do move and how dramatic these numbers are or frankly aren't. The FTSE 100 I put hard in the undramatic category. When we look at the NASDAQ, however, there's a little bit of a sign that at 1.95% for the second week in a row down, something wider is going on within that NASDAQ index. I wouldn't, as I say, necessarily use it as an indicator to go and panic, sell, make loads of changes within your portfolio, but keeping a track of these broader markets can help to understand a little bit more what's going on in your portfolio, particularly depending on the makeup that you have in your portfolio, whether it's individual stocks or whether it's broader funds. These index readings should, in some way, shape, or form, align with what is going on. And as I say, it just helps to understand and to compare as well, week on week, when we're checking out what we're seeing. So what has happened then in the UK to give these overall results? Well, speaking of budgets, I mentioned my own mini budget, but we have, of course, got the UK budget coming up on November the 26th. And it seems to be that it is all that the media and, of course, the political commentators can talk about. We've seen an awful lot of speculation around what Rachel Reeves is set to do. It's a huge decision, and it could really impact what happens with the UK economy and the UK taxation system as well, which in turn impacts us as consumers and how we spend, and of course us as investors and what that looks like in our portfolios. Rachel Reeves has reportedly scrapped the planned income tax rise that she was thinking of doing in the budget. Now, again, we don't know. All of this is speculation, but this has been revealed by sources close to her. But this has actually spooked markets as a bit of speculation, which is why it's worth talking about. Because what all this speculation does, of course, is it does help some of us get some ideas as to what might be in the budget, so we're not totally blindsided on the 26th. But it also gives markets and individuals a lot of opportunity for worry and for, of course, fear around what the eventual outcome could be, given that it is just speculation. So the fear around her potentially not raising income tax is that she won't be able to raise enough money, or indeed she's going to have to take it from other pots to be able to fund the growing deficit in the government. What this has done is it's pushed up gilt yields. So the UK government bonds, it's pushed their value up a little bit. So what that means is that what the government has to pay for borrowing their own bonds has gone up, because people are seeing this as potentially uncertain and potentially not very fruitful. Investors have also questioned that overall political strength and fiscal direction, depending on what she will pick in those tax changes. There's a reported £20 billion gap to fill within how much is needed to be raised by the UK government in the upcoming budget. Income tax would have been an interesting one. Reportedly hasn't been changed by a Labour chancellor for over 50 years. So it's certainly not a well-trodden path. And I think it's fair to say that amongst individuals in the UK, it wouldn't be a popular one either. There are growing fears amongst economists that the UK economy is looking pretty stagnant, and some relatively bleak's a little bit extreme, but some not superbly happy information came out. Data was released last week around the UK job market. Unemployment is slightly higher than what was expected, which really signals that an interest rate cut may well be coming in December. The reason being is that unemployment up normally means that businesses aren't spending as much, and so they're not employing as many people, and it can therefore mean a slowing in the economy. If there's less people working on things, then often the case is there's less output, and output is a key part of that overall economic growth calculation. Now, if we're thinking, therefore, about interest rates being cut, the hope is that it gives consumers a little bit more money in their pocket if they're not spending as much on their mortgages, and the incentive to leave money in cash has just dropped. So they go out and spend a little bit more, give some money into those businesses that aren't employing as many people, and it helps to stimulate the economy. But what else does this potential move away from the income tax rise mean? Well, of course, it means higher borrowing costs for the UK government and just that air of uncertainty once again. This political uncertainty is not necessarily over with the budget either. It's something that all of us as investors need to be ready to weather, and have been weathering already over the last few weeks, arguably even months, as more and more speculation around what she does arises. The date is not this Wednesday, but next Wednesday, so hold tight for that coming. And if you do have investments in the UK, don't expect it to be plain sailing, because whatever the outcome, there will be a lot of sentiment to digest by investors and the markets as well. And it's not just, of course, UK equities. It's also where else investors go in the meantime. It may well be that investors are flocking ever more towards the likes of gold and other bonds as well, until clarity improves on the UK situation. With every situation that we talk about with investing, there's always losers in some cases and winners. There's always two sides to the coin. So don't forget that side either. Again, it doesn't necessarily mean that you flock towards some of those investments, but it's an interesting balance and scales to watch as we see certain assets improve in times of speculation and uncertainty, and others not do quite so well. Over the pond then in the US, where the longest US government shutdown came to an end on Wednesday night. We've got some more political turmoil tied to the markets for you. We'd seen in the US that actually there had been, as I say, a long US government shutdown. And this was starting to impact all sorts of areas, from air traffic control, reportedly saying that they were about to go on strike because they weren't being paid, to other major payments on the cusp of not being paid, including some major benefits payments that go to those who are otherwise not in receipt of salaries. So a spending bill was signed, and this should hopefully keep the US government open until January the 30th, or rather open, chatting to each other and hopefully making some sort of decision rather than being in this utter stalemate that we've seen since early September within the US government. This was really causing a lot of stock market fear. This is a huge headwind within any investor's portfolio, because the uncertainty that a government shutdown creates is not to be underestimated. As I say, the decisions that can or can't be made whilst this is happening, the salaries that can't be paid whilst this is happening, it's absolutely enormous. So the reopening should hopefully ease some of that pressure on stock market worries. That's what you'd at least think. It seems to be that whilst we'd expect this, it didn't quite pan out like that last week. Lots of reasons for it, but it seems to be that the markets are still in fear as to how long it'll take to return to normal, and of course, if it'll just simply happen again. As I mentioned, this is a major headwind on the overall picture of the US, its stock markets, and its government decisions. So that's why when we looked at the S&P 500 at the beginning of this market update, we saw that actually it wasn't looking super rosy for the week, even though this seems like relatively good news. There is ongoing fear as well around the amount of money that has been pumped into AI. Many are talking about the potential for a stock market bubble. It's something that, again, keeps popping up as a key phrase, as a key bit of speculation. The NASDAQ being down, the tech index, is closely tied to all of this fear and speculation around AI and how much money has been pumped into it, and how the potential for overvaluation, aka the companies are worth more in their stock market value than they actually are in reality, is actually playing out. There is a lot of parallels being drawn in commentary between what is going on right now with AI and the dot-com bubble that we saw in early 2000s. The dot-com bubble was tied to the emerging internet market, and I mean that in the broadest sense possible. But it's a very similar situation where we're seeing in new sectors appearing, lots of hype and lots of speculation, lots of excitement, and lots of valuations going up. It could well be that it's not the case. No two situations are the same. We're not in 2000. Nobody can predict it. But it's fair to say that that may well explain why just this US government shutdown ending isn't enough to drive markets into the positive in the US. So what does then all this mean for you and your investments? Well, it means we're still in this ongoing period of uncertainty. If you have exposure to the US within your portfolios, which is highly likely, then you'll be seeing this play out in slightly more muted returns over the last few weeks. There is light at the end of the tunnel. The US government shutdown has ended and it's open for a wee while. With regards to AI, less so, but there's certainly only so long that speculation can go on for. Either we see some sort of correction, we see some sort of slowing, or we see ongoing growth. Any of those outcomes will likely result in clear endings for your portfolio. Some are better than others, but there's certainly short to medium term time horizons that you'll see them play out. On to then the read of the week, where the Financial Times was having a look at what taxes could go up in the budget if the income tax are not rising. Apologies, it was not the Financial Times, it's the BBC News, this read of the week. So the Chancellor, Rachel Reeves, as mentioned, will not raise income tax, but rates still need to be taken from somewhere to be able to raise around 20 billion. This is to meet debt rules, so the budget is likely to include other tax rises. Speculation is around the likes of the national insurance thresholds, income tax thresholds as well. There could also be raids on pension, salary sacrifice and savings tax breaks, possible property tax reforms, and potential new levies like an electric vehicle tax. But none of these, as I mentioned, will be popular. Some will be more popular than others, and some will impact more people than others. Of course, one imagines that Rachel Reeves's main goal right now is to just plug that 20 billion gap in a way that fits with the Labour manifesto, in a way that doesn't hamper economic growth too badly, and in a way that supposedly raids the pockets of those with the broadest shoulders, whatever that means. There is a lot of speculation, and we'll keep talking about this until, of course, we know the eventual resolution. The reason why it's key to know about is, firstly, if you're here in the UK, it's really important to know and understand what the budget could do to your personal finances. But also from a broader perspective, whether you're in the UK or not, you will likely be looking at your investments and how this could pan out. A lot of speculation for the UK or for any market is rarely good. So don't be surprised if we have a bumpy few weeks. So on to then Europe, where firstly, Europe has the EU will impose customs fees on Chinese parcels. It's not just Chinese parcels, and there is already a levy in place. They are just deciding that the pause that they've had on it is going to be removed. There has been a staggering amount of particularly small parcels coming in from China, thanks to the likes of Temu and Shein becoming superbly popular in the EU. The decision to put these customs fees back on these parcels arriving is to do with the fact that the EU believe that they are being swamped, reportedly, by these parcels, and it may be hurting domestic markets given the relatively cheap levels of these parcels that are coming in. It's also to try and curb some import surges and, as I say, protect the locals. So it may benefit European retail stocks as a result, and we might start to see some fluctuations within them over the coming weeks. It'll be a while until these parcel fees are really kicking in. It's not something that can be done overnight, and the EU certainly isn't a jurisdiction that tends to do things on a snap decision. But in the meantime, what it could do is also dampen some of the overall view of the Chinese economy, as one of their major trading partners potentially starts to drop off a little bit. We might also see a bit of a rush on orders for those Chinese parcels in the meantime, as people try and get them in before an eventual tariff import cost comes in. So what does that mean then for you and your investments? Well, there's some individual sectors that could result and look interesting off the back of this. European retail, to mention one. But there are also some that may suffer. If you've got investments in China, for example, this is just another blow to an already beleaguered economy as it stands. On to then Germany, where the German Economic Council has warned of weak recovery and criticised the government's debt-funded investment plan for its poor design. Germany, perhaps a bit like China, but maybe that's harsh, is also struggling with a slightly stagnant economy. They have been for some time. Many for years have seen Germany as the powerhouse of the EU, and it's always had a reputation for surging forward with a relatively strong economy. Unfortunately, that has not been the case in recent years. All sorts of reasons for it. Post-COVID, it's been a tough time. And of course, we've had lots of different headwinds as well, from the conflict in Ukraine to now, of course, Trump's crazy tariffs. But concerns over this stagnation and rising debt within Germany could well weigh on the overall German stock market and German equities. It could also shift potential investment appetite towards other EU markets and, of course, other global markets. If Germany is no longer seen as a stable powerhouse or as appealing, then this could have a long-term shift in investors' minds. So what does this mean then for you and your investments? Well, it's not just Germany that's impacted, but also the broader European Union. This is probably one to watch in the more medium to long term when it comes to your investments. If you have investments in Europe, for example, then it's likely that Germany has been a linchpin of that overall market. If this starts to change, it's not necessarily a bad thing. We could see some new whippersnappers coming through that are really appealing to investors and really generate higher levels of growth. But it could also mean some turbulence along the way. A shift in those kind of dynamics is not normally easily accepted by investors or market sentiment. So watch out for what those changes could well mean within your overall European part of your portfolio. And last but not least, onto the rest of the world. First up, China, who I've mentioned once already in this morning's update. They are struggling. They have reported their sharpest investment drop since 2020, amid falling home prices and of signaling worsening, that's a difficult word to say, worsening domestic demand. China have seen since COVID a real slowing in their overall domestic economy. They also saw a property crash that happened just before the COVID-19 pandemic. So they entered it already in tough straits. China has equally, similar to Germany, I'll use the phrase, been a bit of a powerhouse. They've been one of the major growth nations in the last 20 to 30 years. This slowing isn't new, but it's certainly, again, another update on their economic data that is not positive. It's not necessarily drawing investors in either, and it shows that all the measures that are being put into place are not necessarily panning out how they quite expect. So what does this mean for you and your investments? Well, if you've got investments into emerging markets, it's likely that China plays a role in that. And what we will start to see is that if China continues to slow, others may well step up to the mark. If you've got individual investments into China, it may well have been a tougher time. It doesn't mean it'll stay like this forever, but certainly in that more medium term, it looks like it could take some time with every update that we see of this ilk to really update. On to then South Africa, where there's actually some pretty good news for South Africa. S&P, which is one of the major ratings agencies, so they assess different companies and governments for how secure they are, upgraded South Africa for the first time in 20 years. They upgraded their government outlook from a BB minus to a BB. What this means is that they believe that South Africa is becoming more stable, more attractive, and therefore more appealing to investors. They have cited improved revenues, reforms, and stabilizing debt as the reason for the upgrade. This should mean that South Africa's government has to pay a little bit less for their bonds because they're seen as a more secure bet from S&P at the very least. And it may well mean that more investors flock towards it as they see it as a slightly more stable market. So what does this mean for you and your investments? Well, coming back to that analogy of emerging markets, if you've got emerging markets in your portfolio, South Africa will likely play some sort of part. By stabilizing, this is relatively positive news. And as a section of that emerging market, they may well see some good few weeks, months, and even years if the ratings remain like this. And last but not least, onto Argentina, a topic I could talk about for absolutely hours. The US transferred their $870 million in SDRs, so sovereign debt notes or sovereign debt relations, to help Argentina meet IMF payments. It's actually come from an interesting little pocket of the US's government money. The Congress did not have to approve these payments because they came from essentially the Treasury's personal slush fund. Donald Trump has really close relations with Javier Milei, the current president of Argentina. It seemed to be a move that is more about political relations and strengthening friendships than necessarily the economic or overall investment benefit that comes with this payment. It is supposedly just a loan, so Argentina will need to pay it back to the US at some point. But there's also been quite a lot of hush-hush around the deal, which means that actually we don't know a lot as to what it's going to look like. So what does this mean for you and your investments? Well, not necessarily loads. It's highly unlikely that you've got specific investments in Argentina. And when we're looking at the US's personal slush fund, that doesn't necessarily impact us. But what it does show is that the market and the world we're living in is all about some of those friendships and strengthening political ties. And so when we feel that we're constantly talking about politics, the ties to the markets, our investments, and our overall portfolio and personal monetary outlook is not to be underestimated. Even these links from far-flung countries are seriously impacting how the US government and therefore the US markets could pan out. So never forget that even if it feels far away, it could well still be impacting you. So I'll move now on to the Q&A. Do drop any that you've got into that Slido link, which is hopefully in the chat box. And do make sure that you've seen the link for our event. We're having a fantastic in-person event in London on the 27th of November. If, of course, you are in London, it would be fabulous to see any of you there. I think Lisa shared the link where you can get tickets as well. And yeah, it would be great to see as many of you as we can there.
Amazing. Thank you so much, Zoe. So far, I can only see one question in the Q&A, but if you have any other ones, obviously do pop them in there now. And the question here was coming back to the point that you made about the UK and the budget coming up. And it was, is there anything we should do to prepare for the budget in the UK?
Yeah, that's a good question. And I think different financial advisors, educators, commentators have different thoughts on this. I personally am a believer in it's all speculation, and the way in which it changes, we could get whiplash for how quick it is. I personally wouldn't be making any changes off the back of speculation. When we've got the information and we know what it looks like, then you can think about what your finances and investments need to look like on the back of that. But making snap decisions just on speculation could lead to potentially quite a lot of losses. And it could also lead to a lot of unnecessary stress and changes within your portfolio before we even know what's actually going to pan out. I don't know if you think the same, Lisa.
Thank you so much, Sarah. Yeah, I 100% share that opinion. And I can't see that there are any questions, any other questions at the moment. So if you have any further ones throughout the week, always obviously message us on Instagram or on our email address, which is on our website as well. And do come along next Monday.
Lovely. See you then. Have a great week and bye for now.
Bye.